Are you quietly overpaying the IRS by $50,000, even $100,000 every year and not even realizing it? After helping over 250 high-income earners save over $12 million just in the past 12 months, I keep seeing the same four patterns that drain cash from you and your family without people even noticing it. So in this video, I'll show you why these leaks even happen, what they actually cost, and the simple legal fixes you can set on autopilot this week so more of your paycheck compounds for you and your family, not the IRS. If you're new here, my name is Alec Friel. I'm the founder of Tax Saving Experts. We help high W-2 earners and professionals cut their tax bills and build real long-term wealth with proactive tax planning. Without further ado, let's start with the first taxpayer type that constantly overpays. We call this the April-only filer. The mistake that starts in April costs you all year and takes a couple simple switches to fix. If your entire tax strategy is pressing submit in April, you're paying far more than you should because most of the real savings happens during the year, not at the time of filing. Here's what this looks like in real life. You wait until December to see what's left. You forget to turn on your HSA. You never deducted pre-tax versus Roth in your 401k. You donate to charity but never itemize, and your withholdings don't match your actual income. So April is a surprise. That costs you real money. Missed or late 401k funding can leave upwards to $15,000 on the table completely untapped. Defaulting to all pre-tax and peak years can raise your lifetime taxes by tens of thousands of dollars. And if you give to charity but don't bunch your giving, you often get zero extra deductions or barely more than taking the standard deduction. So here are 5 simple changes you need to make. First, 401k deferral strategy. Set your paycheck deferral so you hit the annual limit evenly instead of cramming all in December. Go pre-tax if you're in a very high bracket this year. Choose Roth 401k if your rate is lower and you are intentionally building tax-free buckets. Next, the health savings account. If you're on a high deductible plan, turn on payroll HSA contributions. Invest the balance, don't leave it in cash, and save your medical receipts so you can reimburse yourself tax-free later. Then the Backdoor Roth IRA. Put after-tax dollars into a traditional IRA and convert to a Roth on a monthly or quarterly cadence. Keep your Form 8606 clean every year so the basis and conversions are documented. Now your IRS Form W-4 withholding alignment. Adjust your W-4 to match your known bonus and RSUs vest dates so taxes are planned and strategized for you so you're not overpaying throughout the year. Finally, charitable bunching through a donor advised fund or a DAF. Pick a single big giving year, donate appreciated stock or ETFs you've held over 12 months. Get the deduction in that 1 year and grant to charities over time. We'll go deeper on DAFs when we hit the third type of taxpayer who will overpay without knowing it. So instead of figuring it out come April, you set your 401k, HSA, and Backdoor Roth to run off of every paycheck. And you mark November in your calendar as your donor advised fund year and month. That one change commonly moves $20,000 upwards to $50,000 into tax advantage buckets automatically while trimming your tax bill. Next up is type 2, the Equity Comp Pro with no tax plan. If you work in tech, finance, healthcare, and get equity compensation, this is usually your biggest silent leak. Equity is amazing until taxes blindside you. Most plans with RSUs default to under-withholding, often around 22 to 24%, which is too low if you're in a top tax bracket. So you get hit with a big balance due at the end of the year. Then if you sell your shares before 12 months, you've turned gains into short-term income at higher tax rates. So what does that cost? Under-withholding RSUs plus short-term sales can add $50,000 to $100,000 in taxes very quickly. Meanwhile, skipping tax loss harvesting when markets dip leave offsets unused when you rebalance or sell later. Do this instead because this is actually what works. First, match taxes to reality. At each vesting period, pre-sell enough shares to cover your true bracket, not just the 24, 22%. If you can't change the rate, sell to cover more to plug the gap. Next, harvest losses on purpose. Set a simple tax loss harvesting rule in your taxable account and avoid wash sales by not buying the same or substantially identical fund within 30 days in any account. Then earn better tax treatment. When your risk tolerance allows, hold targeted lots for 12 plus months so gains qualify for long-term capital gain rates instead of the short-term ordinary income. The third taxpayer type who overpays the cash donor. There's no DAF, no appreciated stock. You give every year, which is awesome. But if you're taking the standard deduction, your giving often does not reduce your taxes at all. And if you're donating cash while sitting on big gains gains in your brokerage, you'll pay capital gains later that you could have avoided. 2 simple moves fix this. Bunch your giving into a single year donor advised fund. Donate appreciated stock or ETFs held over 12 months. You avoid capital gains and you can deduct fair market value this year, subject to your AGI limits, of course. Here's how it plays out. Instead of writing $20,000 of checks every year, you transfer $60,000 of appreciated ETF shares into a donor advised fund this year. You likely itemize this year, get a larger deduction out, and you've erased the embedded gains on those shares. Then you can grant money out to your favorite charities over the next few years on your schedule. Remember to keep your receipts, know the AGI caps for appreciated assets versus cash, and coordinate with your CPA. That's how generosity becomes actually tax smart. And finally, if you're W-2 only with no business, you're leaving an entire part of the tax code unused, and therefore it's causing you to overpay by over $20,000 in taxes. So lastly, the one stream income earner. As a pure W-2 earner, deductions are very thin, which is why you need to start a simple, legitimate side business, and suddenly the tax code opens up. Once you have a real business, IRS code section 162 lets you deduct ordinary and necessary business expenses. Laptop, your phone, internet, software and AI tools, legitimate, regular, and exclusive home office expenses, travel, business meals, education, marketing, different contractors, wages you pay your kids for real work at reasonable market rates. This creates 2 huge wins immediately. You reinvest into your simple side business before tax, meaning the IRS takes a smaller bite, and number 2, you build a second income stream and you build real equity and cash flow. Here's the exact simple copy and paste blueprint you can follow. Register a simple LLC if it fits your state and your situation. Open a dedicated business bank account and keep basic books and records. Document all of your business purposes for your expenses. When profit grows, consider an S-Corp to optimize salary versus distributions. Create an accountable plan for pre-tax reimbursements and the Augusta Rule, if done correctly, for limited tax-free home rental income to you, but losses from your business. A lot of people overcomplicate the process of starting this business, so let me make it real. Let's imagine you're a senior software engineer earning $325,000 a year, and you spin up a small consulting business on architecture and AI workflows. You keep a separate bank account, track expenses cleanly, document every purchase. Over the year, you route $20,000 of true business costs. A few other examples: laptop, monitor upgrades, pro software, part of your internet phone bill, conference, travel, client meals, and documented home office expenses through the business, all pre-tax. At a combined 35% rate, that's roughly $7,000 that you don't need to send the IRS this year. You did not quit your job, you just flipped the tax code to work for you. Those are the 4 taxpayer types that quietly cause you to overpay the IRS by $50,000, even $100,000 every single year. If one of these 4 types of overpaying taxpayers sounded like you, that is normal. Most high earners were never shown how to plan during the year, so they overpay, and it keeps happening year after year. Here's your fork in the road. Either you close this video and you likely overpay another $50,000 to $100,000 come the end of the year, or you lock in a simple personalized plan that keeps more of your paycheck working for you and helps you build real long-term wealth, while also in the short term lowers your taxes. In the last 12 months, my company Tax Saving Experts has helped over 250 high-income earners legally save over $12 million in taxes. So if you're serious about reducing your tax bill and building long-term wealth with proactive legal strategies that actually work, book a free tax strategy session with the top link in my description. We'll help you implement the right strategy tailored to your situation, which lowers your taxes and helps you build long-term wealth. So stop overpaying, start compounding more wealth on purpose. If you'd rather keep learning first, no problem. Watch this next video: 8 assets smart W-2 earners buy, but the IRS hopes you do not. Either way, take one step now. Small legal moves made this week can prevent another year of overpaying the IRS.